Okay, guys, so welcome to today's session. This is the first of the test 4 segment of our MAC 4861, 4862 CTA course. Today we're going to be covering standard costing. If you have a look at past papers, standard costing will basically count about 50% of the paper, between 15 to 20 marks. So standard costing is quite important. So today we're going to take a little bit of time in going through the background, because like I said, doing the background of standard costing is important. It is critical. So if you have a solid framework and solid understanding of standard costing, then when you have to navigate all the different scenarios and subtleties that they put through the question, it'll be a lot easier. So we'll explain to you the key issues, the key things to look out, and we'll go through each formula, or at least most of the formulas, so that you have a solid understanding. Then we will move over into a past paper. The past paper is 2017. In 2017, MAC was the costing of MAC was done in the first half of the year, and then finance was done in the second half of the year. From 2018 onwards, they switched it around where finance was done upfront. Corporate finance was done in the first half, and in the second half they did costing. So you will see we're going to cover, if you have a look over here, we're covering test 2 2017. So for your purposes, it is for test 4 content. So just be aware of that. So let's start off with what is standard costing, or why is standard costing important? So what is standard costing basically used for? In one sentence, standard costing is used for planning and control. So the purpose of standard costing, very basically, is used for planning and control. Put yourself in the shoes of a manager, whether you're the finance manager or the financial director or whoever, and let's say you're working for a manufacturing company. At the end of each year, you plan basically, or close towards the end of each year, you set a budget for next year. So typically how a budget gets set, you will try to figure out, you'll try to determine what your expected sales will be. And knowing your expected sales, you will then know how many items you need to produce. Once you know how many items you need to produce, you will be able to work out the cost. You will be able to work out the cost of each item, or the expected total cost. Now remember, for a manufacturer, the cost of an item is made up of 3 things: direct material, direct labor, manufacturing overheads. Remember, it's very important to understand the cost of a product is made up of 3 things: direct material, direct labor, and manufacturing overheads. Manufacturing overheads can then be split between variable and fixed. Which of the manufacturing overheads you include? It depends on the costing system. If you're using the variable costing system, you only include variable manufacturing overheads. If you're using the absorption costing system, then you include both variable and fixed manufacturing overheads. So now that they identified their sales, they know how many items they need to produce. By knowing which items they need to produce, they can now work out the expected costs they will incur next year. And then how do they do it? They separate each item in the production process. So direct material, direct labor, manufacturing overheads. Now, in the standard costing world, a company that uses standard costing, they'll break it down even further. They know that, so remember, the planning is here to work out how much you expect to spend, and then the control aspect, so planning is before the time, then the control aspect is when you start producing in the year. Month 1 passes by, you will now be able to work out, compare actual of month one to the budgeted of month one. So now there will be a variance, most likely 99.9% of the time there's going to be a variance, and now you can analyze that variance. And this is where the critical part comes in. So remember, there's a planning aspect, then there's a control aspect. We mainly focus on the control aspect where you have budgeted information, actual takes place, and now you compare budget to actual. Budget versus actual gives you a difference. That difference we call a variance. Now we want to analyze that variance. How do we analyze the variance? Well, when you apply standard costing, then the variance can be broken down into two parts, a price variance and a quantity variance. So that is the level of thinking you want. Just remember that you are basically wanting to, you trying to determine whether actual cost is in line with what is expected, with what is budget. When you do the comparison, you get a variance. There will most likely be a variance. Now you want to analyze the variance and you want to determine what is causing the variance. Because you will now be able to analyze and determine the cause of the variance, you can now put measures in place to actually fix the problem. And that's where the control aspect comes in. But like we said, that variance will be broken down into two parts, a price variance and a quantity variance. So that is basically the purpose of standard costing, to set a budget and then to control. So you plan and then you control. So that is the purpose of standard costing. Now we come into how do we actually go about performing the variance analysis. And this is where the big parts come in. But before we go into determining the variances, how do you actually determine the variances? There's a few things you need to be aware of. The first thing I'm going to mention, this is extremely important. It is so important that if you get it wrong, they basically just mark straight zero. Okay, that's how important it is. So I'm pretty like I know on a cycle level they do it. UCT said they used to do it. I don't know if it actually happened, but apparently they did it. So I'm assuming because it happened on a cycle level, they will also do it. They will also do it on a UNISA level, that if you get this one thing wrong, then basically they mark it straight zero. They don't look further at your paper, okay? Because it is a fundamental issue and it is showing that there's a lack of understanding. So what is this important thing? The first thing you must always be aware of is that you need to flex your budget. You probably heard that term, flexing the budget. Another term to make it more simple is you adjusting the budget. So what are you adjusting? So remember, the whole point of standard costing is planning on control. We come in the control aspect where we want to compare budget versus actual, and then there will be a difference or variance, and we want to analyze that variance. Now, a budget is generally set at the beginning of the year for the whole year, right? And most likely, the units actually produced may differ to what was budgeted for. So let's say you budgeted to produce 1 million units for the year, but what was actually produced was 1.2 million. If you compare actual and to the original budget, we call it the static budget. If you compare actual to the static budget, there is certainly going to be a variance, and basically the variance is going to be useless. The variance is going to be meaningless because you're comparing a budget that is based on 1 million units versus actual that is based on 1.2 million units. So as you can see, there's certainly definitely going to be a variance. So analyzing the variance is useless because you're not comparing apples with apples. So in order to make sure that the variance we're analyzing is something meaningful, is something useful, is to ensure that the budget is flexed, that the budget is adjusted to represent actual units. So although your budget is based on 1 million units, you must change the 1 million units and adjust it to represent 1.2 million units. All the other inputs will remain the same. Your standard input, your standard price will remain the same. All you are only changing is actual. So in actual units. So now, when you compare the flexed budget to actual, you are now comparing apples with apples. Your variance you're going to get is now meaningful. It will be useful because both are based on 1.2 million units. So that's very, very important. The first thing you must always look out for is flexing the budget. Always remember that. If you do not flex a budget, in most cases, they're not going to give you part marks because fundamentally, the variance is useless, the variance is meaningless. So we will show you how to flex a budget. The second and the third aspect is not as critical as the first aspect, but it is very important because in most cases, they won't ask you to determine a certain variance. In most cases, they're going to say, dear student, please determine all the variances in as much detail as possible, or all the variances as far as possible, meaning they want to test whether you know which variances are applicable and which variances are not applicable. Now, these two things will play a role in you knowing which variances will be applicable and which variances will not be applicable. So what are the two things? Number one, it is identifying the costing system, whether you're using the absorption costing system or whether you're using the variable costing system. This will have an impact on the variances that will be available to calculate. When we go through the variances, I will tell you where it becomes applicable. The second one is, in most cases, we're going to be dealing with a system that uses the absorption costing system, and the way they allocate overheads is not using ABC, but using the traditional costing method. So when a company is using the traditional costing method, you need to pick up how do they allocate overheads? Are they allocating overheads using an input basis, or are they allocating overheads using an output basis? Output basis means overheads are allocated based on units produced. Input basis means overheads are allocated based on direct labor hours, machine hours, direct labor costs, direct material costs. So those inputs, goes into the production process. So that's very important. Whether using an input basis or whether using output basis also have an impact on which variances you will be able to calculate and which variances you will not. So that's very, very important. So the three important things: flexing the budget, critical. Don't do this, straight zero. Second, costing system. Third, how do you allocate overheads? Okay, how do you allocate fixed overheads, or just how do you allocate overheads? So that's very important. Those are the three things. Remember the purpose of standard costing. You're comparing budget to actual, you will get the variance. We want to analyze the variance. And how we analyze the variance, to break it down even further into two parts: a price variance and a quantity variance. By picking out that, we will be able to determine, we will be able to pick up what are the issues and then provide any corrective measures. Now, this is where CTA become challenging, is that you must be able to provide reasoning. Okay, you need to be able to explain what is the cause of the variance. So there's going to be two things that is important to understand when explaining the variance, the cause of the variance. Number one, it needs to be within the context of the scenario. And then number two, it needs to make sure that you are consistent between all the variances. Maybe not every single variance, but where they may overlap. Okay, so that's very, very important to explain that. Okay, so we will, as we go through, we will explain how you pick up reasoning for variances. It's pretty clear from the scenario, but just make sure it's also in the context of the scenario and you don't contradict between different variances. Okay, so that's very important. So that is basically the core that I wanted to cover. Before I go into the actual variances, there are just two things that you want to set your brain right before the time. Okay, so you want your brain to be in the right frame of mind before you start a standard costing question in particular. It's the same for any costing question, but particularly for standard costing, because it's going to come through like 100%. Okay, so the chance of it coming through is 100%. So you don't want to get muddled up during a paper. So you want to come before the time and make your brain aware of these things so it is alert. You know, like when in any country, for example, in any country, any place of national security, or what is considered a national importance, a place of national importance, like for example, here in Cape Town or in the Western Cape, Kubik Station, I think it's called a place of national importance, national security, whatever. So if there's any thing threatening, let's say the presidency or anything of that nature, those areas will go on high alert. They'll get notified that they need to be on high alert because of A, B, C, and D, right? So same thing over here. When you're doing a standard costing question, you need to put your brain on high alert. So what are the things that you want to be? You don't want to wait for the event to happen before you go into high alert. You want to know that there are possible threats, so you want to be on high alert. So in this case, not necessarily a threat, but it's just basically certain things you want your brain to be wired for before you start a standard costing question. So the two aspects, basically, number one, you want to know what is 1 unit of a product, okay? What constitute 1 unit of a product? So for example, if you are making, let's say in the furniture business and you make tables, then a unit is a table. Now this is critical because remember we said you need to flex your budget. So in order to flex your budget, you need to identify the actual units. Before you can identify actual units, you need to know what is a unit. So that's very important. So if you manufacturing, if you're a furniture manufacturer, then and you're making tables, then 1 unit is a table. If you are Nike and you make shoes, what is a unit? A unit is not 1 shoe. A unit is going to be 1 pair of shoes. Very important. So a unit is going to be 1 pair of shoes, which means 2 shoes. 2 shoes makes 1 unit because you can't sell 1 shoe. You can only sell a pair of shoes. Very, very important. Okay. So distinguish between, you need to pick up what is a unit, and you must separate this from the inputs. So for example, a table, you completed the unit that you sell is a table. But what goes into making a table? It is direct material, which would be wood, direct labor, which would be maybe people, carpenters putting a table together. That's important because when we flex a budget, flexing the budget is going to say standard quantity of input multiplied by actual units. Now, the unit is the completed table. So the table is the unit. When you're looking at direct material, the standard quantity of input is the wood per table. How many square meters of wood per table? So you want to have this bearing straight so that when you go into a question, your brain is on high alert. He knows or she knows they need to separate a unit from the standard quantity of input. So each item will have a standard quantity of input. Direct material will have its own standard quantity of input. Direct labor will have its own standard quantity of input. Variable manufacturing overheads will have its own standard quantity of input. So for example, with a table, each table uses 2 square meters of wood. So when you want to flex a budget, you're saying SQI, standard quantity of input, multiplied by actual units. Actual units, the completed table. Standard quantity of input for direct material is the square meters of wood per table. Very, very important. For labor, the actual units is the completed table, but the standard quantity of input for labor is perhaps the hours per table. Okay, the hours per table. Very important. So the first thing, identify what is a unit, and then separate that from your standard quantity of input in order to produce a unit. In the shoe example, your shoes perhaps made out of plastic, or let's say leather, and so 1 unit is 2 shoes, but they are telling you each shoe uses 50 millimeters of leather. Each shoe uses 50 millimeters of leather, but you want to multiply that by actual number of shoes, actual units. Remember, each unit is 2 shoes. So it's very important to keep your bearing straight. And this is where most people get confused, because they only become alert when they read the scenario. They don't train their brain to be on alert. You don't need to know what the information is about. All you need to tell your brain, we need to be on high alert, separate actual units, separate a completed unit from standard quantity of input. Very important. The second aspect that you need to be aware, the second aspect that you need to be aware of, the second aspect that you need to be aware of is the following. What is the second aspect that you need to be aware of? Is how they present the information per quantity, per unit. For example, they may tell you that labor hours, each table takes 15 minutes per table. So each table takes 15 minutes of labor time, 15 minutes of labor time. That is the standard quantity of input for each unit. And the price per labor hour is 20 Rand. So what do you notice? The quantity of input is in minutes, but the price is in hours. You need to make sure they are the same. My rule would always be keep the price as it is, keep price, whatever they give it, either give it in hours, keep it in hours. Then you convert the minutes to hours. Similarly with the direct material. Let's say we said each shoe takes 50 millimeters of leather, but the price they most likely give you in meters. So what do you do? Because price is in meters, you convert the quantity of input from millimeters into meters. Okay, so that's very important. That doesn't matter how you want to convert, but like my general rule is keep the price as is, convert the quantity of input. So those are the stuff you want to be on high alert. So before you start a question, you tell yourself, we must be aware, we must be aware of the following. What must we be aware of? Flexing the budget. We must look out for the costing system. We must look out for what did I say? How they allocate overheads, and then tell your brain to be alert in separating actual units. What is an actual unit? And then separating actual unit from standard quantity of input. And then the next one is making sure that you keep yourself aware and you are alert on how they present the information, whether labor time is given in minutes, but the price is given in hours. You need to do the necessary conversions. So that is the background, what you need to just keep yourself aware of. Okay. So now we're going to go into, the actual formulas. Okay, so we're going to go through the various formulas. And once we go through the various formulas, I will run through certain of the stuff I just mentioned now as I go through the formulas, so that when we do start tackling a question, we will be in a better position. What you want to come to the point where when you read a standard costing question, you can already answer it in your head without even going to your writing it down. Okay. Obviously, you won't necessarily be able to do the actual number, but you know the formulas that must go through your head. Okay. Before I go on to standard costing, before I go on to the various formulas, is there any questions from your guys' side? Let's just see who's here. Ashita, Benice, Faid, Fakir.
Yeah.
No questions.
Lerato, Benice, Nasreen.
No questions.
All good.
Rebecca, Felice, Ryan.
No questions.
No questions.
So now we'll go on to, now we're going to deal with the actual variances. So in most cases, what's going to happen, they're going to say, dear student, please reconcile the difference in profit. Please reconcile the difference between budgeted profit and actual profit in as much detail as possible. So they're going to say, dear student, please reconcile budgeted profit to actual profit in as much detail as possible. Okay, so we're going to break it down. We're going to do it first simple, then we'll expand it, then we'll expand it. Okay, so we'll expand it. We'll do it, expand it twice. Okay. My approach generally is as follows. Remember, sometimes they give you a template and you must do it in their way. But if they don't give you a template, then we do it this way, right? Whichever way they give it is basically the same thing. I'll show you how they'll generally give it or how they may give it. So when you go study this, you might just make sure you can do it both ways, okay? When you study this, you must make sure you can do it both ways. Like I can't do it both ways. Well, I don't think I can still. I'll have to think through it in order to do it both ways. I do it the one way, but obviously I'm not writing an exam. I don't need to know it both ways. So, but once you do the one way, you just basically switch it around for the other way. But I'm gonna show you my way first, so that if they don't give you a specific way, we do it this way. And then I'll just quickly spend about 2 minutes showing you how they sometimes give it to you in an exam, and then you have to reconcile it in their format, okay? So for me, I look at it and I'm like, if I was in management accounting, if I was a management accountant, my manager does not care how it gets presented, provided it's understandable and we can actually explain the variances. So in most cases in the real world, they don't care how you set it up, provided it actually does the job, and provided anyone else, if they pick it up, they will understand it. Obviously, you can't do it anyway such that only you understand. You need to think, if I must present this to the finance manager, if I must present this to the board, would they understand what is happening over here? That is how you think through it. So the way I do it, I'll say, I will have budgeted profit. Okay, so I'll have budgeted profit, meaning they're either going to give it to you or it somehow is going to be quick to calculate. Similarly, I will have actual profit. Either they're going to give it to you or it's going to be quick to calculate. Then we're going to get a difference, or in costing, we will call it a variance. So we have a variance. Okay, so you have budgeted profit, you have a number, you have actual profit, you have a number, and then you have a variance. Most likely going to be different. Now, all we're going to do is the following. Remember, this budgeted profit will just have to be flexed for actual information. Okay, so now we're going to get a variance. Then all we do is we're going to say reconciled as follows. So now we're going to reconcile it. So in most cases, remember, what is profit? Profit is sales minus costs. What do we know? That cost can be broken down into variable and fixed. In most cases, the cost we're going to be dealing with is only manufacturing costs. But the same process would be if in the event they give you a non-manufacturing cost. But for our purposes, I'm going to ignore non-manufacturing costs. I'll only deal with manufacturing costs. So like we said, profit is sales minus total costs. Total costs can be broken down into variable costs and fixed costs. So basically my variance will be a sales variance, and it will be a production variance. You'll have a production variance and a non-production variance. I'm not going to deal with non-production variance. I'll only deal with production variance. But what do we know? Production variance is not just one thing. Production is made up of a number of items. Remember, the cost of a product is made up of three things: direct material, direct labor, manufacturing overheads. So basically, I'll have a direct material variance, I would have a direct labor variance, and I would have a manufacturing overhead variance. But we will split it up. We will have a variable manufacturing overhead variance, and we will have a fixed manufacturing overhead variance. Okay, so that's important to take note. Okay, so basically that is how you think through it. I have budgeted profit versus actual profit. I have a variance. I need to reconcile the variance. What am I reconciling? The difference in profit. What do I know? Profit is equal to sales less costs. From a costing point of view, costs can be broken down into variable and fixed. So then we list all our variable costs and we list all our fixed costs. Now remember, you have production costs as well as non-production costs. We're only dealing with production costs. They hardly ask you for non-production. If they do, the way you treat it is same like production costs. Okay, so I'm just going to stick to this. So basically, that is our variance. But we know that in standard costing, the variance is broken down into at least two parts: a price and a quantity, or a quantity and a price variance. So my thinking is that I run my thinking like this. Okay, I tell myself the variance is sales and production. Production is direct material, direct labor, variable, and fixed manufacturing overheads. Those are the variants that run through my head. But I know each variance is most likely two: a quantity and a price. So what do I do? So I have my two, I just have two, what you call it? Okay, so what do I know? The sales variance, we will have a volume variance. The volume variance for sales is basically your quantity variance. And I would have a price variance. Same with direct material. The variance is broken down into two: a quantity variance and a price variance. Same with direct labor. I'll have a quantity variance. Now for direct labor, we don't call it quantity, we call it efficiency. Efficiency, okay, efficiency variance and a price variance. So we don't call it a price variance, we call it a rate variance. Just think about it. In your contract, if you get paid on an hourly basis, do they call it your price per hour or do they call it your rate per hour? So just think about that, okay? So remember, each of us have a quantity and a price. What we call quantity may differ. What we call price may differ. So don't get bogged down on the terminology. Obviously, try to use the right terminology as far as possible, but don't get bogged down. Don't let terminology give you sleepless nights. Make sure you have the thinking process going. Then we have variable manufacturing overheads, same as direct labor. And then for fixed manufacturing overheads, remember fixed manufacturing overheads, by definition, it means that it does not change relative to quantity. So fixed manufacturing overheads is different from direct material, direct labor, and variable manufacturing overheads, because those are variable costs. It change relative to the activity, units produced, whereas for fixed manufacturing overheads, its very definition says it is fixed because it does not change relative to output. Okay, so be aware of that. So here we can also have two variances, a volume variance and we call it a spend variance. Okay, so we have a volume variance and a spend variance. So this is the first level of thinking. So the first level of thinking is, if you say, dear student, please reconcile budgeted profit to actual profit. Then we say budgeted profit compared to actual, we get the variance. We say it's reconciled as follows. It's reconciled through a sales variance, a direct material variance, a direct labor variance, a variable manufacturing overhead variance, and a fixed manufacturing overhead variance. Even simpler, it is through a sales and a production variance. A production variance is made up of those four things that makes up the cost of a product. But then I tell myself, I know for standard costing, we have each of those variances can be split into two, a quantity variance and a price variance. What we call a quantity variance may differ for each of them. What we call a price variance may differ for each of them. But basically, there's a quantity variance and a price variance. Okay, so that is basically how you think through it. Before I expand this and go a little bit further, there's just one, let's explain how they may ask it. I do it like this, okay? But in some questions, they'll give you the format and then you have to stick to the format. So in some places, they're going to do it like this. Okay, so I'm just going to use the other page, other sheet. So in some exams, they're going to say, start off with budget profit and then end up with actual profit. So basically, what is in between over here is what I have under reconciliation. Okay, so basically, what is in between budget and actual is what I have under reconciled as follows. Alternatively, they will say, start off with actual profit and get back to budgeted profit. What is in between over here is basically what I have between reconciled as follows, okay? So what is in between here is basically what I have at the reconciled. So you can see my method and these two methods exactly the same, just how it's presented. But the critical part here is, if they ask you to do it, you have to do it this way. So what is the important part here is the direction. Okay, so if you start with budget, for example, maybe unfavorable is negative and favorable is positive. Whereas when you start from actual to budget, then it's other way around. So if in a scenario, we can do it this way, we do it this way. But what you must do for yourself, you take the exact same scenario and you replicate it by starting with budget and getting to actual, starting with actual, getting to budget. That you must do. I'm not going to do it. That you guys going to do. And then, because you need to get your thinking straight in terms of which direction. Everything else in terms of the actual calculation will remain the same, but it just basically whether it's negative or positive on the variance. Okay, so that's very important to take note. So I'm not going to deal with that. I just want you to know that in some exams, I've seen it, they'll tell you, do it like this, and then you need to do it like that. Then you can't do it this way. Even if it's 100% correct, they probably give you 0 if they wanted to. Okay, so just be aware of that. So now we're going to go through the various formulas. Okay, so now we're going to go through the various formulas. Then we'll go to the next level of expansion. So for the quantity variance, I'll come back to sales. For quantity variance, when you're dealing with a quantity variance, the constant is standard price. Okay, so when you're dealing with a quantity variance, the constant number is standard price. So the formula is standard price multiplied by. Now this bracket over here is flexing the budget. So this bracket over here is where we flex the budget. So this bracket over here is where we flex the budget, and we're going to say standard quantity of input multiplied by actual units. Now, this is why you must train your brain to get this, to think about this before you hit the standard costing question, because otherwise you're going to go insane. Okay, maybe not insane, but close to insanity. So, what is the standard quantity of input? So, if we're doing tables, tables are made with wood. Let's assume you're doing it into wooden tables. So the standard quantity of input for direct material is how much wood do we budget per table. Like an example I gave earlier, 2 square meters of wood per table. So SQI is 2. Then actual units is the number of tables for the year. The number of tables we produced for the year. So if the number of tables for the years was 1,000, you can see actual quantity, actual units is 1,000 tables. SQI is 2. So therefore, in total, the standard amount of wood should have been 2,000 square meters. Okay. Now you will compare that to actual quantity. So the actual quantity, let's say, for example, it is, so this will be actual quantity used. Actual quantity. So I'm putting used big. I'm not doing that for nothing. Okay, so you must use actual quantity used. So if actual quantity used is 2,100, you can see you're supposed to have used 2,000. You've actually used 2,100, so you know the variance must be unfavorable. Okay. So inside of this bracket over here is only the quantity. But remember, we are reconciling profit. Profit is a rand number. It's a value. So to get it into a value, we multiply it by the standard price. Okay, so we multiply it by the standard price. Then we come to price variance. When you deal with price variance, the constant is actual quantity. The constant is actual quantity. So in this case, we're going to say actual quantity multiplied by. Now we're going to compare pricing. Remember, we're comparing pricing because we're dealing with a price variance. So what we're going to compare is standard price versus actual price. Standard price versus actual price. And we multiply it against the actual quantity, because remember, when you buy wood from a board company, they don't care what you budgeted to buy. You must pay them based on the quantity you actually purchased. So that's why when we compare the price variance, we use actual quantity, because what we physically paid the board company is based on the actual quantity that we purchased. Very important. So that is why what we use is actual quantity. As you can see over here, this here is comparing standard quantity with actual quantity. With the quantity variance, we're comparing standard quantity with actual quantity. The only key thing over here, standard quantity was converted based on actual units. And we keep the price constant. Which price do we use? We use the standard price. In the price variance, what we're comparing? We're comparing pricing. So therefore, we're saying standard price versus actual price. The constant is actual quantity. Just remember that. So same thing here with the efficiency variance. The efficiency variance is basically our quantity variance. So what are we comparing? We're comparing quantity. We're comparing standard quantity with actual quantity. And what do we keep constant? The price. So the price we keep constant. So we're going to say standard price. Now remember, when it comes to labor, we don't use the word price, we use the word rate. So I'm saying standard rate multiplied by, now we're going to compare standard quantity with actual quantity. But remember, for standard quantity, we need to flex the quantity. So what do we say? Standard quantity of input. That will be how much time was budgeted per unit. So in my earlier example, we said each unit takes 15 minutes. So that is the budgeted time. But now remember, because the rate is in hours, you must convert that 15 minutes into hours. So once again, like I told you, as you can see, those formulas are becoming a lot of things to keep track of. So before you start standard costing, put your brain on high alert. What they must be on high alert about? There must be on high alert regarding what is an actual unit. I mean, what is a unit? Is it, do you need to identify what makes a unit? And then you must also separate a unit or distinguish a unit from quantity of input. And the other thing you must put yourself on high alert is how information is provided. Labor time is in minutes, yet the rate is in hours. So make sure they're both on the same units measurement. So you must do this before you do a standard costing question, because when you start dealing with the formulas, you're going to be zoning into the formula. It's easy to forget. But if your brain is on high alert, it's going to know that when it's dealing with the formulas, from the back of its mind, it's going to let you know you're on high alert. You're on high alert. We're working with minutes, but we should be in hours. Things like that. Okay, so that is strategies to avoid getting confused and getting all mumbled up in a standard costing question. So there we have SQI. Remember SQI, the standard quantity of input per unit. This is labor. So the standard quantity of time per unit, 15 minutes. We need to convert that into hours. So whatever that is multiplied by actual units. Now, this bracket over here is giving us our standard quantity of input. It's giving our standard quantity. Okay, so it is the amount of time that is required per unit. We now need to compare that to actual quantity. Okay, so remember, in this case, our quantity is hours, so we say actual hours. Like I made mention, the way I do it, I always tell myself quantity and price. I ignore terminology of efficiency. I ignore terminology of rate. I ignore that. I just tell myself quantity and price. First, make sure I get the basics right. So the formula is for quantity, I'm comparing standard quantity with actual quantity. To get standard quantity, I must flex. So it is SQI times actual units. When I'm comparing quantity, actual quantity with standard quantity. So my price remains constant. My price is the standard price. When I deal with price variance, I'm comparing pricing. So if I'm comparing standard price with actual price, what I remain constant? My quantity, and I use actual quantity. That's all I did when it comes to standard costing. Once I knew that, now I spent some time in getting the terminology right. When do we say efficiency? When do we say rate? I don't even think they care, but maybe just for your own purposes, you may want to care. Okay, so that's very important. I just want to make this clear. This here is actual quantity purchased. Okay, so I'm putting it in bold so you know it's quantity purchased. Whereas in the quantity variance is that we use the quantity used or quantity issued. Once again, we come to the price variance for labor. What are we doing? We're comparing actual standard price to actual price. And then what do we keep constant? Quantity. Which quantity? Actual quantity. So I will say actual quantity. We know the quantity is hours. So I'll say actual hours multiplied by I'm going to change this to be consistent. Okay, so it's actual hours multiplied by, that's the constant. What are we comparing? Standard price, we call it a rate, minus actual price, we call it a rate. Okay, so that is basically it. How do we do it for variable? Exactly the same as labor. Okay, so basically same thinking when it comes to labor. Just understand for the actual information. Sometimes you're gonna have to maybe work out some aspects of actual. So actual info, remember the actual number. The actual number is, they're gonna generally give you a total for actual. So remember the total for actual, I'll just put it over here. The total for actual equals actual quantity times actual price. So sometimes you need actual hours, or you need actual hours, but you are given that. So you want actual hours, which is actual quantity, but you given that, and you have to rearrange the formula to get the unknown. Okay, so just be aware of that. Let's go to sales. We'll come to fixed overheads just now. Now let's go to the sales variance. I'll start with the price variance. With the price variance, what do we do? With the price variance, what do we do? Once again, we're comparing pricing. So it's going to be actual price to standard price. And then the constant is going to be quantity sold. So this is going to be actual quantity sold multiplied by actual selling price minus standard selling price. For the volume variance, we're comparing volume, quantity. Okay, so what are we comparing? It is actual quantity sold versus budgeted quantity sold. Okay, what do we multiply it by? Remember, in the quantity variance, we multiplied it by a standard price. Now, it's slightly different when it comes to sales. When it comes to the sales variance, or the sales volume variance, we use budgeted contribution margin or budgeted gross profit. So as you can see, it's not both, it's one of the two. So how do you know which one to use? So like we said, at the beginning of when you start reading a standard costing question, you want to pick up three things. You want to pick up two things: the costing system and the basis for allocating overheads. So if you're using the variable costing system, you will use contribution margin. If you're using the absorption costing system, you will use gross profit. Okay, remember, you use budgeted, so just be aware of that. So that is basically how you calculate it. So why do we use a gross profit or contribution margin, whereas over here we just used the price? Why don't we just use a standard price over there? Because remember, when you lose a sale, you're not only losing the selling price, you're also saving on the cost. So if you're using the variable costing system, you're losing out on the sale, but you're saving on the direct material, direct labor, and variable overheads. So ultimately, what are you saving on? What are you losing out on? You're losing out on the contribution margin. Similarly, when it comes to absorption costing method, you may be losing the sale, but you are saving on the direct material, direct labor, variable and fixed manufacturing overheads. You're saving on the cost of sales. So in effect, what is happening? You are only losing out on the gross profit. The opposite is true. If you're selling more, you're making more money, but you're also incurring more costs. So basically, the benefit is not the selling price. The benefit is the contribution margin, or the benefit is the gross profit. And that is why we use gross profit or contribution margin over here. So remember, when do you use contribution margin? If you're using the variable costing system. When do you use gross profit? If you are using the absorption costing method. But here it's where it plays an important role. Let's quickly go over here quickly. So for budget, for fixed manufacturing overheads, the spend variance is basically budget minus actual. Okay, so this is generally like 2 marks. You're given actual, given budget, you calculate it. Okay, so remember, it doesn't follow the same pattern as these, because by definition, fixed cost does not change relative to units. So therefore, you just stick budget, so you don't flex the budget for fixed manufacturing overheads. Okay. Then over here, the volume variance, basically fixed overheads applied minus budget. Okay. So the volume variance is fixed overheads applied minus budget. Now, I made mention that the costing system is important and the basis for allocating overheads is important. Okay. So the question is, why is it important? We already saw why the fixed, the costing system is important. Because if you need to do the volume variance, you must know whether to use CM or GP. That depends on the costing system. You use contribution margin if you're using the variable costing system. Use GP if you're using the absorption costing system. But under the production cost, it also plays a role. If you will only have the volume variance. You can only have the volume variance. You can only have the volume variance if you are using the absorption costing system. If you're using the variable costing system, no matter how hard you try, you're not going to be able to calculate the volume variance. That is why I said it's important, because you may then, like in this question, they said, calculate the variances in as much detail as possible. So how do you know which variances must you calculate? So they are testing whether you know which variances are applicable. They're not tricking you. They just want to know whether from a understanding point of view, you know which variances are applicable when. So you can only have a volume variance if you are using the absorption costing system. Similarly over here, you can only have an efficiency variance for variable manufacturing overheads if overheads are allocated using an input basis. So remember we said what is inputs? Direct material, direct labor hours, machine hours. Those are examples of an inputs basis. An outputs basis if I allocate overheads using units produced. So it's very important when you see the costing system, you must tell yourself, if I must do a volume variance for sales, then I must use CM or GP. If you see the costing system, you must already be able to tell yourself whether you will have a volume variance for fixed manufacturing overheads or not. Okay, so that is what you want to do when you read the scenario. Similarly, when you pick up the basis for allocating overheads, if it is an inputs basis, you must know you will be able to calculate an efficiency variance for variable manufacturing overheads. But if it's an outputs basis, you must tell yourself that you will not be able to calculate an efficiency variance for variable manufacturing overheads. You can only calculate a rate variance. This year, they don't call it rate, they call it, they actually call it a spend variance, whatever you want to call it. Okay, so so just be aware of that. So then you will only have a spend variance and no efficiency variance for variable manufacturing overheads if you are using an outputs basis for allocating overheads. So those are the key things that you want to be aware of. So that is the basics. So like we said, number one, always remember to flex a budget. How do we flex a budget? This is flexing the budget. SQI times actual units, okay? Number two, pick up the costing system because the costing system has an impact on which variances you will be able to calculate. Number three, identify the basis for allocating overheads. If you're using an inputs basis, then you will have an efficiency variance for variable manufacturing overheads. But if you're using an outputs basis, then you will not have an efficiency variance. Okay, very important. Now we're going to break down some further. In many cases, or in some cases, the quantity variance can be broken down further. So in some cases, the quantity variance can be broken down further into a yield and a mix. Same thing over here, it can be broken down into a yield and a mix. The question would be, when can you have a yield and a mix? Remember in this question, they told us to calculate the variance as far as possible. They're not telling you which variances they want. They're telling you to calculate as far as possible. So you must know which variances you are able to calculate. Okay, so you must be able to know which variances you are able to calculate. Now, when can you have a yield and a mix? If for direct material and for labor, I'll explain from a direct material point of view. The same thinking applies for direct labor. If you have more than one direct material and those direct materials are interchangeable. So if you have more than one direct material and they are interchangeable, only then is a yield and a mix possible. If you only have one direct material, you can't have a yield and a mix. Or if you have more than one direct material, but they are not interchangeable, then you can't have a yield and a mix variance. Very, very important. You won't be able to have a yield and a mix variance. Similarly, for direct labor, you may have different levels of labor. If they are interchangeable, then you can have a yield and a mix. If they're not interchangeable, you can't have a yield and a mix. In many cases, materials can be mixed, okay? And then you will have a yield and mix. But in some cases, like for example, perhaps like in a pharmaceutical business or chemicals industry, the ratios of each product must be precise for it to be effective or safe. So then in those cases, you can't play around with a mix and a yield. But in other cases, you may be able to play around with a mix and a yield. For example, look at clothing, pick up a label of clothing, right? Then it will tell you 95% cotton, 5% polyester or whatever. Now, that you, I mean, I'm not 100% certain, but I'm pretty sure that you can play around with a mix of cotton and polyester, right? So you will play around to see what is more favorable. Obviously, you're not going to play around with it just from a numbers point of view. You're obviously thinking from a business perspective. The numbers is one aspect, the business perspective as well. You can maybe put more polyester. It may make the quality cheaper. I don't know. But let's just say, for example, makes the quality cheaper. What happened? Your brand gets tarnished and so forth. So there's other stuff to consider, but just to bring it to our minds, closer to our minds, that is basically a place where you can play around with the mix and the yield. Okay, but maybe in a chemicals business or pharmaceutical business, the exact proportions has to be in place. Otherwise, it may be a bit dangerous. So then you can't play with a mix and a yield. So when is a mix and a yield? When there's more than one direct material or more than one direct labor, and those are interchangeable. Okay, so that's important to take note. Lastly, for fixed manufacturing overheads, the volume variance can also be broken down into a capacity variance and into an efficiency variance. But remember, you can only have a capacity and efficiency variance if you have a volume variance. And you can only have a volume variance if you have an absorption, if you're using an absorption costing system. So if you use an absorption costing system, you will have a volume variance. But it does not mean that you have a volume variance that you can break it down into a capacity and efficiency. You can only break down the volume variance further into a capacity variance and an efficiency variance if the basis for allocating overheads is an input. So if you're using the absorption costing method and the basis for allocating overheads is an output, you can have a volume variance, but you can't have an efficiency and a capacity. But if you're using the absorption costing method and the basis for allocating overheads is an input, then the volume you will have a volume variance, and the volume variance can be broken down further. So just be aware of that. Now remember, the sum of those two will equal the volume variance. You're just taking the volume variance and you're breaking it down further. Similarly over here, the sum of the mix and yield will equal the quantity variance. You're just taking the quantity variance and you're breaking it down further. So just be aware of that. To end off, I'll give you the format for a mix and a yield. We won't do the question now. We'll do the question in the next lesson. Okay. So to do a mix and a yield, here's a format. Okay, so gonna have standard price. Going to have details. Then you're gonna have SQI. You're gonna have revised SQI, and then you're gonna have actual quantity. Okay, that will give you a yield variance. That will give you a mix variance. Okay, so what you'll do, I'm going to make up stuff, okay? I'm just going to make up stuff. So the standard, this only works, makes sense when we do it via an example. So let's say the product we have is material A and material B. So let's just assume that material, there's more than one material, and the materials are interchangeable. So therefore, we can have a mix and a yield. So material A, we have material B. Just let's make up a number. The standard price is 10 Rand, and let's just assume it is in meters. So 10 Rand per meter and 12 Rand per meter. So the standard price, 10 Rand per meter, 12 Rand per meter. Let's, for argument's sake, on a total level, so standard quantity of input times units, right? So standard quantity of input times units. Let's just say we should have the standard quantity of input says it's 9,000, and for this it is 11,000. I'm making stuff up, okay? Okay, so let's just see the standard quantity of input. So remember, how do you get standard quantity of input? SQI. So let's say 2 meters per unit times the number of units. Let's just say over here 1.5 meters per unit times the number of units. Okay, so that's how we got to 11,000. That's how we got to 9,000, whatever it is. Okay, actual. Let's just say actual came to be 9,500. And let's just say 10,800. So they gave us this, that's what it comes to. So now I can work out the total. So I'm going to say sum and then I'm also going to say sum. Now remember, this 20 and this 20, these numbers are meters. It's the quantity. Okay, it's not a Rand value. It is the measurement unit. So this is 9,000 meters, 11,000 meters, and so forth. So the revised standard quantity, we're going to say, so what all we are doing is, we're saying it should have been like that, based on standard quantity. Actual was this. So what were we saying? What should all the revised quantities doing is saying, if we use the standard proportion and we multiply it by the total actual quantity used, what should it have been? So what we're doing over here, we are saying for material A, the proportion is 9,000 divided by 20,000. That gives us the weighting for budgeted quantity multiplied by the total actual quantity. So we are saying we should have used 9135. We actually used 9,500. We do the same over here. 11,000 divided by 20. So we're getting the weighting of product B. So we're saying what percentage of product B, what percentage of all the material is product B? So we're saying 11 out of 20. That is similar, you think about WACC. So what percentage of total material should product B be? So if I have it like that, you will see, let me just show you quickly. If I have it like that, we're saying product B should be 55% of all the material. Okay, so now we're going to say multiplied by the actual meters used. So we should have used 11,165. Okay, so that is basically what we are doing over here. So all we are doing, you're going to see now, if I add this up, what you can see, the revised quantity equals the actual quantity. All the revised quantity is doing is saying, given the actual quantity used, so we used 20,300 meters, what should it have been if we had to use the standard weightings? Okay, that's all we are doing. That's why we call it the revised SQI. And now we can get our yield. Our yield is basically SQI minus revised SQI. And let's see what's this doing. Okay. And then over here, the mix is going to be revised minus actual. So the mix in quantity will always add up to 0. Okay, so the mix in quantity will always add up to 0 because you're comparing revised versus actual. As you can see, the 2 is exactly the same. So the mix will always come to 0. But remember, we want a value. We don't want quantity. So now we're going to work out the value. So this is how we work out the value. So in an exam, if you get this, you basically just use this as a template. Okay, so now how do we get the yield for material A? We go yield variance material A multiplied by its standard price. We go yield mix for material A multiplied by its standard price. Then we go for material B, yield for material B 165 multiplied by its standard price. And then mix for material B multiplied by its standard price. So that's basically it. As you can see, for the mix, if you have a look at the mix in quantity, it is 0, but the mix in value as a number, Y, because the standard prices are different. So just be aware of that. So this is the actual answer over here. The total yield is that, total mix is that, and this 2.6 negative, that should equal the quantity variance. Okay, so whatever the quantity variance is, must equal this. If it's not equaling that, in some way we went wrong, because remember, the mix and yield is just a further breakdown of the quantity variance. All we are saying, the quantity variance is 2.6, but all the 2.6, it's a negative 5,000. Sorry, all the 2.6, it is a negative 3.3 for the yield, with a positive 730 for the mix. But ultimately, it's a negative impact. Okay, so basically that's what we are doing. So that's how you can do a mix and a yield. But remember, when can you do a mix and a yield? If there's more than one material, more than one labor, and they are interchangeable. If they are not interchangeable, then you can't have a mix and a yield. And obviously, if there is no, if there's not more than one material or no more than one labor, then you can't have a mix and a yield. So that is basically what I wanted to cover today, just to have a big back framework, so that when we attempt this question, so I'll send out, we're going to have another lesson this week sometime, either on Friday or Saturday. I'll just confirm, and I'll tell you when we will have it. I'll send it, I'll let you know by Thursday, which day. So I want to be able to have a lesson on Monday coming. So to make up Monday's lesson, I'm going to do it over sometime this week. Okay, so I'll let you know. Then we will tackle this question, the 20 marker standard costing question. But what I want you to do in the meantime is to make sure you understand the purpose of standard costing. You make sure that you know that you must flex a budget. You must identify the costing system and why, what does it impact, and you must identify the basis of allocating overheads, why and which variances it impacts. Then you want to train your brain to be alert to pick up two things. Number one, what is a unit? And then to differentiate, to distinguish a unit from quantity of input. So like we said, a unit could be a completed table. The quantity of input could be wood, could be hours, so forth. Similarly, the other one was for a unit, you're selling shoes. So a unit is not one shoe. A unit is a pair of shoes. And then you must distinguish between the quantity of input in terms of leather, this, and the other. Okay, very important. The second thing would be to distinguish, to pick up the issues relating to how they provide the information. Labor hours, labor time could be given in minutes, but the price in hours. So they say each table takes 15 minutes. Labor is paid 12 Rand per hour. You can see it's not the same. So you want to be aware of that so you make the conversion. Like I said, I would usually convert the quantity and keep the price as is. So that is the important things to be aware of. Then when we come to this, the actual formulas, tell yourself you are basically trying to reconcile budget to profit. Sorry, trying to reconcile budgeted profit to actual profit. It will most likely be a variance. The variance, because you are reconciling profit, it is sales less costs. Costs can be broken down to fixed and variable. So we will have sales, production costs, and non-production costs, but you can ignore non-production costs. So it is sales and production costs. So we'll have a sales variance and a production variance. But what are our production variances? It is direct material, direct labor, variable manufacturing overheads, fixed manufacturing overheads. Then you tell yourself, for each of those 5 variances, they can be broken down into a quantity variance and a price variance. For the quantity variance, we're comparing standard quantity to actual quantity, and we're holding the price constant. Which price? The standard price. For the price variance, we're comparing standard price to actual price, and we're holding quantity constant. Which quantity? Actual quantity. So that is basically, and then you can run the formulas through your mind. Then you can go further and saying that for certain quantity variances, you can break it down into a yield and a mix. When can you do so? And so forth. So that's what you're going to get. Just get that framework and the frame of mind right. And then when you do a question, you know that at least the fundamentals is solid, so that when we tackle a standard costing question, we can focus on the nitty-gritties of the question, which is going to have to keep your head up straight when we deal with a standard costing question. So that's all that I wanted to cover. I just wanted to know, do you guys have any questions from your side? Yeah, so
No questions.
so remember the worksheet is already in the folder, the Mac 4861 folder. The video I'll load up by tomorrow. Okay. Okay, anything confused on your guys' side at this point in time? So do you have a question? And if no, anything confused? Ashita, Bernice, Faid?
No, nothing confusing.
Okay. Ashita, Bernice, Fakir?
No questions and nothing confusing at the moment.
Rebecca, Ryan?
No questions.
Okay.
Nothing confusing.
Okay.
I also no questions
Okay.
and nothing confusing at the moment.
Okay, so we will go into what you call it. So the question that I'll be covering is Mac 4861 Test 2 2017. So what you guys can do, go through it so long, right? With this background, I'm going to save it. I'm going to save the question. It's let me just see. Yeah, so it's going to be I'm going to save it as cut letter 103 2019 Mac 4861. Okay, so it's Mac 4861 cut letter 103 2019. So it's test 2 2017. Okay, so you can work through that. So come prepared for that class that I'll tell you when we're gonna, by Thursday I'll tell you that the exact date we're gonna have the class. Just a quick gauge, what do you prefer at this point, Friday or Saturday? I don't think I'll be able to do Friday, but just in case I can do Friday or Saturday, which one would be better? Friday night, obviously, Saturday morning. No one's
Saturday morning.
Saturday morning. Okay, so we'll do it Saturday morning. Okay, so we'll do that. I'll send it out. So what we will do is over here, I'll send you the videos by tomorrow, the video by tomorrow. What's already in the folder is the standard costing thing. I'll save the calculator now in the folder. You should have access to the folder. Just let me know if you don't. Okay, so that's all from my side, guys. So standard costing. I just want to show you something quickly before you guys go. I'm going to share my screen. So here you can see. So we're going to do this. They call it test 4, but it's previous 2017 test 2. So question 1, 20 marks. Okay, so question 1, 20 marks. That is the standard costing question. So here's all the information. It's only one page. That's positive. Only one page. So they're keeping it simple. Then here's the required. Okay, so they required A, determine the total budgeted variable production costs. Remember, you must be able to distinguish between what is a prime cost what is a conversion cost, what is variable production cost. So variable production costs or variable manufacturing costs, direct labor, direct material, variable manufacturing overheads. So variable production costs, variable manufacturing costs is your three variable costs: direct material, direct labor, variable manufacturing overheads. Prime costs, that is direct material plus direct labor. Conversion costs, direct labor plus overheads, manufacturing overheads. Okay, so just be aware of that. So here you can see, calculate all the appropriate variances in respect of the 2017 financial year. They're not telling you which variance they want. They're saying, give me all the appropriate variances. So some people's going to sit there forever if they don't pick up the costing system, if they don't pick up the base of allocation. But in some cases, so if they give you the variable costing system, then you can't have a volume variance for fixed manufacturing overheads. If the basis for allocation is the variable costing system, then you can't have an efficiency variance for variable manufacturing overheads. You can't have a capacity and an efficiency variance for the volume variance for fixed manufacturing overheads. So just take note, those kind of subtleties makes a big difference. But sometimes you don't pick up that, then you stress because you can't calculate a variance because they just say all variances, so you think must do every possible variance. So please, those kind of small things make a big difference. Okay, then they say, then provide the journal entries for the material variances, including appropriate narrations. Okay, we will deal with that when we come to the actual, when I cover it with you. Then they say, motivate whether or not, in your opinion, business is a sustainable business. Okay, we will see whether that is. Okay, so you can attempt that, and then in our next lesson, we're going to cover it. Okay, then you can see the next 20 marks. They say calculate the minimum cost for business space. This is relevant costing. So out of that's 11 marks. Okay, we'll see what all the other stuff is all about. So here you can see relevant costing taking up about 10 marks. So that is 25%. Standard costing taking up 20 marks, that is 50%. We'll do some more other past papers and we can see also what's the ratio. That gives you an indication on what's important and what is not so important. It does not mean the others are not important, but it does give you an indication, it does give you a trend. But remember, they can switch it around, but it does at least gives you a direction as to what is important and what is not so important. Okay, guys, so I'll stop here. I'll see you guys tomorrow for some of you. And then for Mac, I'll see you later in the week. Okay, bye-bye.